Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is December 27th, 2017, and I thought I would take a look at lean hogs today because it's triggering a pivot high here. But that is in contrast to the trend that is to the upside here, short, intermediate, and long term, all pointed to the upside. We have the technical rating obviously pointing to the upside. And it's the seasonal tendencies that we're really going to focus on here tonight because there's something kind of interesting to watch here. Now we do have short-term overbought pivot high condition that is actually occurring here, but we're also at a point where we're going to show this as well. The deep dive on the patterns and lean hogs, the HOGS ETF, generated a T-rope high. And what that means is that there's an environmental condition that is taking place here. So the fact that we have a pivot high that is occurring in the elastic level, it is somewhat superseded by the fact that we have a T-rope high. What the heck is a T-rope high? Well, let me explain. If we take a look at lean hogs here, here is a daily chart here. Here is the pivot high that is occurring here in the elastic level that is telling us that the market is overbought. It's overbought, no doubt, the fact that we've had 4 or 5 days here to the upside. And you'll see that it is meandering in around the 200-day moving average. Now, when we look at this, let me see if I can pull this up here. Yes. Okay, so here is a little plus mark here, and that is the T-rope high. And the easiest way to explain this is T-rope stands for tightrope. And normally, instead of a T-rope high, which is what we're looking at here, the naming structure comes from a T-rope low, meaning that the market comes down to a 200-day moving average. It acts like a tightrope, and the market, for the most part, acts as a repellent. In this particular case, the 200-day moving average of the market would move higher if it was a T-rope low. But what we're looking at here is the market has surged to the upside. We have a T-rope high, meaning that it is hitting resistance at the 200-day moving average, and it has, at least for the day or so, has fallen back a little bit. Now this is an environmental change because anytime you have a crossing of the 200-day moving average, as simplistic as that is, it is still important. That along with the 50-day, but for the most part we look at the 200-day because it doesn't happen all that frequently, and when it does, it has a tendency to be fairly strong. So if we take a look here again, here is a plus sign, meaning the white. We have the white pluses. We've got 3 of them here, and we have another one that is occurring right now. And if you look back historically, here is one of the T-ropes where it came through, it found some resistance, it popped up, and then fell through. We had more of the generic case where the market came up to the 200-day moving average and truly found resistance before falling to the downside. Again, we find ourselves in the traditional sense where it has come to the 200-day moving average, but is there a possibility that the market could still have a little bit of life to it and actually break through and follow suit here? So if we take a look at the supports of the market, we have one back through here. It's 8, not very strong by any stretch of the imagination. And that's is kind of corresponding here with the 50-day moving average. And then we have another one here, right through here. It's a 14, not particularly strong, but still nonetheless resistance that is kind of pegging this high here, maybe a little bit to higher than there, and it's really looking at something that hasn't really hit as of yet, but it came very close with the high as of today for lean hogs. So the fact is that we're finding a little bit of resistance, but the major resistance, this 37, that's really the resistance that is more traditional. So for my money, the systems are long. The systems are on a short-term basis, they're a little winded. They're running up against the 200-day moving average, but we have support of the 50-day moving average. We're a little bit winded, meaning that the elastic level has gotten a little bit of its head of itself. But for all intents and purposes, we would like to see the market, if it's going to have any type of reversal, find some type of resistance at, in this case, 74 and a quarter. I'll just round it a little bit, which is what this represents right through here. So we'll see what does take place, but the wind in the sails here, if I can pull this up here, if we take a look at the seasonal top 10 lean hogs, this is something that this is the top 10 systems, top 10 markets, I should say. Lean hogs leading the way. We have 4 time frames. That's what the 4 represents, meaning we've got the 5, the 10, the 15, and the 20 year, all seasonally accurate, which is what the gray line represents. This blue line represents the accuracy on average for the 5, the 10, the 15, and the 20 year. So what this is telling us is that right now, the current year is following suit with the 5, 10, 15, and 20 year seasonal tendencies. So let's go ahead and take a look at the accuracy charts just to give you some perspective here. And this might be if you come down to here, we're going to look at lean hogs. So we just simply click on lean hogs. And what we're really going to be looking at is what is traditionally going to take place with the market. So this was run as of the 22nd here. And let me see if I can update this, because I know we updated it. Nope, it's not showing here. But what you'll see is that the seasonal tendencies are still modestly strong for the remainder of the year. Not too many more days here. Then there's a little bit of a dip in January, and then we have some volatile surges, the best way to really say that, all the way into early February. So those of you that might be trading the ETF, the Hogs, HOGS, which is a combination of lean hogs and cattle, but still the meat market as a whole, that if you wanted to look at that particular market, on the ETF and or on the future side, it's not a bad time to start nibbling and getting into a bit of a position. Our systems, the net position is long the market. We're down a little bit on the trade, but we're also up against that resistance, that T-rope high, which is what I've been referring to. So let's see what does take place here. The seasonal tendencies are still modestly strong through the remainder of the year. When you take a look at the 10 years and the 15 years, it's hard to see, but it's at least it's not dramatically down by any stretch, and it is setting up for a really nice pop in the market, which will come here in mid-January. So it could be a little bit early. The T-rope high, which what I was referring to, in this particular case, T-rope high, high 00, meaning today's action, that it could be premature. We could see what actually does take place here with the 200-day moving average. It could stop, do a reverse, as I was referring to before, and which is what it traditionally should do. Then it should come back down, maybe find some form of support, and then have the next surge up, which theoretically could be happening here in January. But I'm setting the stage so that you're at least aware that this is taking place. The fact that the systems currently are long the market. Yes, we're having a T-rope high. Yes, the elastic level is showing a pivot high. And we're doing this at a point where there's not a tremendous amount of support or resistance to the market. So again, this could be premature, but the reality is that the market, for the most part, we could see some nice little surge here if we get some type of retracement, and then there'll be another surge here in January. So just be aware of that, be aware of it, take advantage of it should it actually take place. And if we're in a position where we'll be able to come up and really test this resistance level, the 74 and a quarter, between now and then, that would be great because the systems are long. But if we're able to break above that, then we have a nice nice gap, if you will, between that level and this higher level, which I'll just say is 79 and 3/4, almost 80. That's the major resistance that we're going to be looking at in this particular market. So a lot of this is just kind of setting the stage, but I wanted to point this one out because when you look at the patterns, this third tier here, lazy, T-rope, EQ, and KS, these are all environmental change conditions where something dramatic is going to happen. Either A, we're going to break above the 200-day moving average, we're going to have that surge, what I've been talking about, and those resistance levels will start to come into play, or it's really going to find resistance here, it's going to sell off a little bit, and then recover and have hopefully another surge to the upside based upon what the seasonals are telling us. So it could be premature, or we could be dead on. But this environmental change condition that sometimes when you obviously break above a 200-day moving average, that the market really has a tendency to surge here. So we're at one of these forks in the road type condition. Either way, you're going to be looking for long the market either now, taking advantage of the potential, or B, you're going to wait for a retracement, let the systems recover a little bit, generate another trade, find some support to the market, and we'll have another opportunity here in mid-January. But I want you looking at lean hogs. I know some of you don't trade it. I've talked about this in the past where it's really good for a traditional S&P type portfolio. We'll deal with that maybe down into another deep dive. But for right now, I want you to pay attention to lean hogs and see us run out. There are opportunities that are going to arise here based upon this T-rope high condition that's taking place. And because it's a high, you view this as a repellent, a resistance level. That's its traditional sense. But truly, the environmental change condition just simply means that theoretically the market could break through this, and that the analysis that has taken place will turn on a dime, and that this can have a totally different viewpoint on where the market is headed. That's really what the environmental change is looking at, and live with conditions as they are. That's why I want to address this high that is occurring in lean hogs. So we'll take a look at another market tomorrow, and I appreciate it, and we'll go from there. Bye-bye.